Coming up on the SBS On the Money podcast, is the cost of living crisis over? Some sector rotation on the ASX and another successful debut on the market. All the details next. Hello everyone, it is Thursday the 3rd of July. Welcome to the SBS On the Money podcast, where you can get consumer finance and markets news you can use without the fluff. The Australian share market holding steady today, the S&P ASX 200 down 0.02%, so that's basically steady, 8,595, but it does follow a record close yesterday. And while the index implies that there wasn't much action around, indeed there was, in the form of what appears to be a sector rotation out of the banks into the miners. So to discuss all of that, including the manager's recent note, which asked the question whether the cost of living crisis is over, I spoke with Matt Wacher, the Chief Investment Officer at Morningstar. So, Matt, the ASX has really underperformed the US, which hit a record overnight again, the S&P 500 and NASDAQ. Why do you think we saw this underperformance?
Well, I have to say today, maybe it was just one of those days that our market needed a break. At one stage, the Aussie market, it was down about 1%, just before lunchtime there. It's recovered a bit from that, but it doesn't seem like there's anything specific driving or was driving those losses. Potentially some profit taking in the banks, which obviously have been at kind of record highs, CBA in particular. That might have pushed has pushed the market a bit lower at times. And maybe, in the middle of the day there when China opens, some renewed kind of tariff jitters. We've got the mini Liberation Day coming up on 9th of July for us.
Okay, you mentioned the banks. We know that CommBank has been hitting record highs over the past few weeks. A lot of analysts over the past few months saying that that's happening despite it being overvalued. Today, though, it's down. BHP up quite significantly, up more than 4%. Are we starting to see a rotation from financials into resource stocks? And what's prompting this particular move today?
Yeah, we're certainly seeing that rotation today. I'd say that there's many Australian equity managers, investment managers out there that are hoping that this is a longer term rotation after being caught underweight CBA for probably a number of years now. It's been a big pain trade for lots of investors out there. But I guess what's been driving it today, we saw the iron ore price hit about a 3-week high overnight, 95, 65 it got up to. That's really lit a fire under, as you said, some of the bigger miner names, BHP up over 4% today, Rio up nearly 2%. And that's really been on the back of, China's steel industry and some of the caps that the Chinese government are trying to put there. The steel industry, it's been in overcapacity for quite some time. That's been really driven by, record exports in 2024. You would have seen that. And the government's really trying to reduce that capacity and make their steel mills much more profitable, which that was getting a bit out of hand over the last couple of years. And this should really be good for the iron ore price. It's also driven up coal prices, and we saw some of the coal miners jump today as well. But in general, what China's trying to do is fix its deflationary problems by cracking down on overcapacity, not just in steel, but across the board. And if this actually, ironically, if this results in higher inflation, that's actually viewed as a bullish signal for the Chinese economy and subsequently commodity demand. And so our miners have done really well, and that's really been funded in a mini rotation today. It's been funded by CBA and the other banks, which have come off pretty significantly in the face of the mining stocks. They're still not too far away from their all-time highs. And we'd say, the sell-off today in CBA and some of the banks, it's not unwarranted. They've been trading at very high multiples. But really, the question will be how much longevity this rotation actually has in the markets.
Can we spend a bit of time on one of the notes out from Morningstar earlier in the week, which caught my attention, because Morningstar said that the cost of living crisis is a thing of the past. Can you elaborate on that, especially in the light of weaker than expected retail sales numbers that we got yesterday from the ABS? And is it just a function of the fact that we're going to see lower interest rates in the near future again?
Well, that's certainly part of it. My colleagues have certainly come up with a catchy headline there, caught some attention. But I guess the key things are, yes, interest rates, we believe will come down. I think that's a general consensus in the market now. We think, probably next week we'll get a interest rate cut. That seems to be a foregone conclusion for the market. ANZ joining that bandwagon yesterday. But actually, the markets are predicting about 4 cuts over the next 12 months, or 1% of interest rate cuts, and that should really drive, or free up consumers to be able to spend. At the same time, with inflation having fallen so much, household incomes are really growing again in real terms now. So incomes are growing faster than inflation. There was obviously a period there where that wasn't the case, 2022 and even 2023. And the savings rate, it's normalized. So the savings rate got down to about 2%, and it's back up to about 5%. And that's a really positive sign. And consumers, when they've got, when people have money in the bank, they actually feel more confident to actually go out there and spend. And so all of this points to, in the future, a better environment for consumers. And as you say, while the retail sales numbers, especially this week, have been pretty underwhelming, we'd say this is it's a backward-looking piece of data, and we think there's room for optimism into the future, which should flow through to the retail sector. And because retail sales and the consumer have been quite weak lately, there's actually some reasonably attractive valuations on offer as well. So we think some tailwinds for that sector to come.
Okay. Can we talk about IPOs? We've had a few hit the market over the past few weeks. Virgin Australia, the big one recently, which is still above its $2.90 IPO price. Also a successful debut today of a luxury housing developer called GemLife. What does the performance of these say about the appetite for new listings from investors?
Yeah, I think that investors are craving IPOs. It kind of become over the years a staple for retail investors and investors in general. And they've really been starved of opportunities in the last few years. Many Australian businesses have done the reverse and have left the ASX boards. And they've gone private, either to private equity, to super funds. And these have been really high quality businesses that are now in private hands. So what we saw recently, Bain taking Virgin to IPO. We thought that Bain was asking a little bit too much, but it was very borderline. It was a very close call for us. And if you believe, that the good times are still ahead for the airlines, they've done very well. Everyone's trying to get out and travel. Then we think that you can generate some reasonable returns based on that IPO price. For GemLife, it started today well. I think at one stage they thought it was going to open up 20%. I think it opened about 5%. So we'll see what happens there. But as I say, in general, we think that having more public companies as opposed to private without the transparency there, we think that's a better outcome for all investors. Individual investors in particular. And if they're getting shut out of those opportunities, then they're probably missing out on the chance to meet their long-term investment needs as well if they don't get access to those. So we think it's a good thing, IPOs coming into the market.
And so finally, given the economic environment that we're in, there's still a lot of uncertainties out there, and the situation's always changing almost day by day, right? How are you feeling as an investor? What are you telling your clients, and what are the opportunities out there at the moment?
Yeah, we're pretty boring. We always tell our investors, you got to look through this short-term noise and focus on the longer term. But in the short term, all this volatility can also create some opportunities. And so in Aussie equities, we're generally preferring the retailers and miners where we think there's more upside. As we've spoken about, we think the banks are a little bit stretched in their valuations. So we're trying to avoid those and look under the hood for some of those better opportunities. Globally, back in April, we went looking for some bargains in the face of all of that volatility we experienced in April. And we were looking for names that had really been beaten up on the back of the tariffs and also that long-lasting China slowdown. So we bought a few luxury names: Burberry, Louis Vuitton, and even retailers like Nike. And what we've seen even over the last few days is that even a small bit of good news can really push those names that have been beaten up much higher. And so we think that there's still opportunities under the hood, but at the aggregate level, we'd say that US is probably still getting back to levels where it probably requires some caution to be investing. And generally speaking, we wouldn't be surprised to see some more volatility on the horizon. Emerging markets, they're offering some attractive opportunities as well. But what we'd be doing, and we'd be trying to look through that noise, as I said, and if there was more volatility, we'd be looking to buy some of the less expensive parts of the market if that sell-off does come again.
That is Matt Wacher there from Morningstar. The market now looking to US jobs figures, which will be out later tonight. That ends the SBS On The Money podcast for this Thursday. Don't forget to give us a rating or a review if you enjoy the podcast on Apple Podcasts and Spotify, and to click subscribe.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.